Welcome to the next event here at the Carnegie DNB Retail Tech event. For our next presentation, we are joined by Magnus Larsson, CEO of Pricer. Welcome, Magnus.
Thank you very much. Nice to be here.
Good to have you back. And I was thinking maybe we could just dive in if you feel ready. Yeah,
of course.
All right. So it's been an eventful few years at Pricer. Could you just start by briefly summarizing the highlights that you would like to point out now since you became CEO in 2022?
Absolutely. So I joined as a CEO. I joined the company in 2019, became CEO in February 2022. And at that time, it was obvious to me there were a few things that really had to change. The first thing was the growth. I felt that the growth sort of died out after a couple of fantastic years. So the first thing we did was to focus on how can we restore growth, and there were a number of things we did. And when I look back, I actually did it now prior to our meeting, that if I look from the order intake side, where you can see the biggest growth, we have had a CAGR of a little bit more than 20%, then obviously year on year since 21. So that was the first thing, to really see how can we address the market in a different way and make sure that we become attractive again, because we had actually been losing market share. So I think that has been a highlight. And looking at the order intake, I think compared to 21, and I took over in February, so I think it's fair. We managed to increase the now ending 24. We had an order intake that was almost 80% higher than the one that we had in 21. So that's one thing. Then we also had to work with our profitability. Clearly, our operational costs were too high. Our gross margin was too low. So this was a pretty painful work, actually, over quite some time, where we're looking at how do we design our products, how do we do the procurement of the products, where do we source them, do we have enough suppliers. So there was a lot of work by the R&D team, a lot of work by the product team. How do we price the products? Can we actually increase the pricing, and how can we motivate our customers to pay more? So that was on the gross profit side, which we have been increasing quite a lot. On the operational side, it was clear that we had way too high costs when I took over. So when I look at the OpEx back in 22, I realized at the same amount of money that we can actually employ one person, our competitors could employ almost two people. Or actually, we did two and they did three, so there were clearly a discrepancy. But we didn't actually have enough money to make the restructuring. So that was the third thing that we really had to do, was to look at the strengthening our balance sheet. So we did bond, we did new share issues to make sure that we would actually have the necessary money to grow the company. So that's the three key things that we've done to take us to the point we're at today. What we did last year, after actually doing much of this work, was to also spend time on the strategy. So we have a brand new strategy where we look at what is the way going forward for the company. And you will see more of that this year in terms of how we address the market, the products we will actually bring to the market. So that would be the top, I guess, four.
Yeah, that's a great summary. Let's dive a bit further into some of these points, and we start with the growth. Naturally, like you mentioned, the long-term trend is good. I mean, you had an impressive CAGR. If we look for the both medium and the long term backwards, but then also revenue on a quarterly basis can be somewhat sluggish, which we saw here in Q1. But could you just remind us some things to consider when we look at the order intake for individual quarters? What's some considerations here in terms of time from order to revenue and so forth? Some things to consider there.
So it's always very customer specific. We have some orders where you can clearly see you get the order, especially if we have a customer with an existing frame agreement. We take Carrefour as an example. So if you're a retailer, you have your own store, you have money. Or financing, they would typically give us the order, and they would expect to have a delivery within a month, maybe, or 2 months. So very fast. Then we have other suppliers. So the order we got from Sobeys in Canada, it's the second largest grocery retailer. We got that in December, but we also know that we had to do some R&D of our ESLs, adding encryption capability on a new level. So we know that that order that we got in December will start being deployed as of now in April. So we have started to deliver now and ship to Sobeys, so everything went according to plan. But it will actually continue to do this. It's a 250 store rollout that will continue until basically first quarter next year. So it's a little bit hard to really give any good guidance. But what I can say is that we solely base all our order intake on actual purchase orders that we got from our customers, and it's extremely rare that there are changes or cancellations. So if you see an order intake, it's based on an actual purchase order, and it will generate revenue.
Yeah, that's great. Thank you. And if we look at on the customer side, things are moving very quickly in that space. I mean, there's a lot of things going on at the same time with the inflation. There's price wars, labor scarcity, and so forth. Could you just remind us how are these factors impacting their propensity to invest, and what is the current state of your customer in terms of investments?
We can see if we look at some kind of general trends, we see that there are a lot of retailers now looking at how to actually improve the cost and actually lower their cost of the operational costs. So this is both a good thing and a bad thing. It's a good thing in the sense that for them to be more efficient and be able to actually lower their operational costs, they will need help. And typically we would provide that help in terms of making their store operations more efficient. That's actually what we help with them primarily. The less good thing is, of course, that we had an example of Carrefour announcing a big cost cut program where they actually took money from IT investments. That's one example, to actually make a discount on their consumer products, on the food, basically, to regain market shares. It was a bit unexpected, but also that we managed to turn into something comparably good, as they wanted to gain market share. So they would typically say that it's a price war they will enter. So they cannot go into price wars. So then our salespeople went to Carrefour and said, if you now want to do this in France and Spain, you really need to invest in our products, because that will actually help you. If you want to change prices frequently, that's probably the best investment you can do. So we gotten a lot of investment from them last year, but maybe not on the level that we were hoping for. When it comes to inflation, typically you would think about that something bad, and it is bad for the consumers. But from our point of view, it's a good thing, because it actually means that there will be more price changes. And at a certain point of time, if inflation is high enough, which it has been historically over the last years, it's not feasible to do manual changes of pricing. So we have had, in 23, we had retailers saying that we were not planning to invest now, but we have to, because we just don't have the staff enough to make sure we have the right prices in the store.
Yeah, thank you. Would you say it's a challenge then if customers are facing some margin pressure then to convince them to make these kind of investments where they are standing currently, instead of maybe carrying out some additional cost savings? Or how do you feel that customers are currently balancing or doing the trade-off between those two items?
I think normally they keep them separately, so they would look at the operational cost and then they will look at the gross profit they make in the store. But at the end, it will be store profitability that guides them. We look at if it is individual store owners, franchisees, we help them with financing. So that's been a success factor in like France and Italy. So we have a number of leasing companies where we can actually help them set it up. But it's also something that actually helps us get more business.
Yeah. You also mentioned the margin side, and of course you made a great improvement on the gross margin from the low points a few years ago. Could you just remind us on the factors impacting the gross margin and what you've done to achieve this expansion in the gross margin?
Yeah. So the basics was that we've been working a lot with the production and the procurement. We redesigned our ESLs. It turned out that many of them were quite specific. So now we build one platform to do all our ESLs. So we reduce complexity. So this has actually improved the gross margin. We have introduced more production partners. We have increased the numbers of suppliers of displays, batteries, any kind of components. We've done procurement in a different way, but we've also been working very actively with sales. So we try not to focus on the cost of the ESL when we sell, but the value we deliver to our customers. So my target to my head of sales, Mats, has been that we should always be at least 10% more expensive than competition. I see now that when we win, we're sometimes almost 20% more expensive. But to get that right, to win at that price, you have to earn it, and you have to make sure we spend enough time. So when we don't do proper sales engagement and spend enough time with our customers, we don't win. Then it will become a competition win. If we're not looking at the value we deliver and we do the segmentation in a poor way, we try to sell our products so customer doesn't really need it or need to do that frequent price changes or want to work with the product to digitize the store, well, then we will probably also lose. So there's plenty of business for us to win, but we have to engage in the right way. And when we do that, then we actually also increase our gross margin.
Yeah.
Then the product mix, we can see that there are some markets there is a legacy where the pricing is lower. But we also see that we have the opposite, where we have markets where we have really good margins on a level that is way higher than other markets. Then we get positive contribution for adding our SaaS service Plaza, from adding support contracts. And then, of course, the new generation of ESL has higher margins, even when we sell them at a lower price or market price.
And you mentioned the recurring revenue and the product mix. I was thinking, if we break down maybe gross margin improvement from the point where we are right now into external versus internal factors, do you feel that there are additional internal factors that you can work on to improve the gross margin even further?
Yes, luckily I do. I think there are more things we can do to actually improve.
Yeah.
So that's a target. We haven't guided on the future, but I see there's still more we can do.
Yeah, that's great. And I mean, in terms of the pricing, you mentioned that you try to apply then a premium to competitors. Could you break this down? I mean, the ESL of today have many additional applications, maybe from just only a few years ago. But what is the main use case of today? I mean, of course, depending on market and customers and many things, but what are the main use cases, if you were to describe them today, of the ESL, of the full system?
There are quite a few, but the key ones. So imagine you're a retailer and you want to buy a system to digitize the store. Often, I were just now in discussion with a very large retailer. They say they want to have an ROI of 2 years. I told them we should try to aim at getting that down to 18 months. And to do that, there are 3 main use areas, or maybe you could say 4 soon. But the first one is price changes. So you look at the number of price updates you need to do. What is the cost of your staff to do that? So it's quite easy equation. The second thing is that when you do replenishment, if they have a system to lead their staff finding the right place in the store, we know that by just a small change that we, within a sub-second, flash the ESL when they get nearby, we in average help them to find the label maybe 20 seconds faster than doing it manually. And we have done a lot of tests having really experienced store staff, having unexperienced store staff, and both with the unexperienced, obviously, but also with experienced staff, we actually we save a lot of time. And then they can do the math and they say, okay, what is the amount of products we actually replenish and put back? That's a big chunk of the savings. So for customers that have not done it or have not planned to do it, we very often push for it and ask them why and how can we help them to make it happen, because that's a big chunk of the saving as well. Then there's a lot of retailers, especially grocery retailers that have, you can buy their grocery online, but it's actually picked in the store. So if you go to a store and see people with a steel cart and 5 or 10 shopping bags, they're picking online orders. And the same there, we help them to direct them to actually get the picking done faster. Every single pick they make 10 to 20 seconds, sometimes even 30 seconds improvement. So those 3 will actually make up the bulk of the business case. Then now in ours, we are working with a customer that have computer vision installed, and we know that the saving they get from the cameras and AI they have deployed already, we can we can almost increase it with 50% just by doing the combination of our technology and their technology. Then we have more use cases for store staff. So imagine you go in the store. We have one customer every morning, they flip to another screen that is only for the store staff, where they can see what has been the sales, the number of products, the sales price this week, what is the next delivery, what is the stock they have, do they need to order. So they get all the information they need to really manage the in-store operation at the shelf edge. So it will make them some money, but it's a little bit more hard to actually make a business case out of it, but we can clearly say it improves the efficiency and also the store staff satisfaction.
And with the environment shifting so fast and new technique being applied all the time, how do you make sure that you stay on top of the development and always have the best system available in the market?
So what we've done is actually, this has been part of the change we've done of the company, that we have clearly separated the research part from the development part. Somehow before it was a little bit more like one unit. So now it's clearly separate. We have a separate budget, we have set up a separate team, and we have a limited number of areas that we really focus on. So that we want to check these specific areas. It's not ground research, but it's somewhere we work with a few companies to take their technology and see how we can adapt it. And then we have some stuff where we actually do research for our own purpose on our own technology. And then, of course, then we continuously check what's happening on the market. We get a lot of customer feedback, but as part of the strategy, we also did research. So we had 2 independent companies research the UK and US market and then test it on some other markets to see what is the plans of the current retailers. What will they invest in the coming couple of years? How do they look at standardization, retail, IoT, computer vision, of course, deploying of shelf labels. So we have had a lot of customer input also here on where they will spend the money and how we'll work with it. So I think we had more than 200 respondents giving feedback, and this was retail executives and procurement people.
Yeah, thank you. If we could maybe go back then to the last reported quarter. I mean, the revenue was we saw some of this sluggishness that we can see sometimes on the revenue side. But could you maybe elaborate a bit market-wise, maybe highlight some markets that were performing maybe not as good as you anticipated, maybe some markets that were better than anticipated? What was your like sort of market-wise view of the first quarter?
We could see that if I start with the fun part, the markets have performed better than I expected. Or it was Canada, which was not very surprising actually. So, and then the Benelux region, which been a little bit colder, but we're seeing that we will come back, and that we're getting orders both from new customers and also established customers. France was definitely colder than before, and we've seen it. We could see it also in Q4. But on the other hand, we have had fantastic years. In 23, we had almost 1 billion Swedish krona sales in France only. So we know that was peaking. So that wasn't a level that we didn't expect at that time either. Then we've seen that there was, and customers have been a bit careful in general on many markets. We clearly see that both on the order intake, but also on the net sales part. So disappointing, absolutely. As I also stated in the presentation, we see that there is a risk that Q2 will be affected as well, and it's hard to predict what the future will look like also for the rest of the year. But I think the good thing is that we haven't had any customers that said that, no, we will not do anything. On the contrary, they sort of confirmed that, yes, we will go ahead and we plan to do investments, but from a timing point of view, there might be delays.
Yeah. And would you say that this cautiousness among customers is both within current existing framework agreements and maybe sales outside of that, or where was this cautiousness maybe most obvious?
It's been a combination actually. With all the customers where we have framework agreements, we have continuous dialogue. So with most of them, we have at least weekly meetings, so we know pretty well what they plan to do. And then they might have different budget setups and budget cycles as well. But we haven't seen any business disappear. We haven't lost any customers.
Okay, yeah.
So I'm carefully optimistic.
Yeah. Yeah, and then speaking of the opportunity, I mean, there's a number floating around in this industry about 10%, which is sometimes referred to as the market penetration. Is this a number that you agree with? What do you say is the maybe overall, if you look at maybe Europe, maybe like Americas, what is the ESL penetration and what market opportunity do you see mid to long term?
We absolutely agree with that number. I think that the installed base of ESLs globally now is a little bit more than 1 billion ESLs. The addressable market is probably, if you look at all different segments, somewhere around 10 billion ESLs. If I look at the sweet spot where we know that if we address these segments like hyper and supermarket within grocery, do it yourself, large pharmacies, that's really our sweet spot. If we address those, maybe the addressable market is 4 to 5 billion ESLs. So it's still a major market, and we know that when we focus on this instead of trying to win a fashion store, as an example, or a small convenience store, we know that our chances of winning is much higher. And this is also an embedded part in the strategy, that the resources that we will have, we will spend them a little bit more focused than we have done before. So even though it could be tempting to go for a specific deal, we will actually say no, because I want our sales team to focus on the deals where we are quite certain that we have the ability to deliver a very true value and sell at our premium that we want.
All right, that's great. Thank you. And I was thinking, before we conclude, are there any questions in the audience? Maybe both Swedish and English is welcome.
Can you give some key figures for
Just
shares? I haven't followed Pricer for a long time. What is your price earning, and what is your prospect for the next 2 years?
So we don't forecast, but what we did last year is we introduced financial targets, and what we said is that we want to have a long-term growth that should be in line with market growth, or at least 15% year on year. And of course, that means we can still have one poor year, but then we need to compensate with a much better year the year after, so over time. We also want to be profitable, and we target a CAGR or an EBIT over 8% long term, which we actually almost reached last year, but I was about to say that was almost an accident in work. It wasn't. It was, of course, our intention, but it's the long-term target. So that's what we see. What else? It's been a little bit up and down. If you haven't followed us for a while, it's been a little bit up and down, and now, of course, the intention is to make it more up than down. But it will be up now for us to, of course, also to show that.
All right. I think there will be time for additional questions, but for now, we have to say thank you to Magnus, and thanks for coming here today and answering our questions.
Thank you very much.